Alrighty, well, my name is Paul Yanoni, and to start off, I wanted to talk to you guys about the nature of debt financing. So, financing are the funds that the small business owner borrows and must be repay with interest. So, debt financing is also a popular tool that entrepreneurs use to gain capital. So, borrowed capital will allow an entrepreneur to maintain the ownership of their business, but will be recorded as a liability on the balance sheet and will have to be repaid eventually. So, although small businesses are considered high risk, they pay higher interest. Most of the small firms pay above the prime rate, which is the interest rates that banks charge their most credit-worthy customers. So next is sources of debt capital. So the first is commercial banks. So commercial banks are the very heart um, of the financial market for small businesses, which it provides the greatest number and variety of loans to small companies. So small banks are more likely to extend loans to small businesses than a large bank. So 58% of business loans that are made by small banks are to smaller businesses. 32% of business loans from mid-size banks are smaller loans, and 19% of the business loans from large banks go to small companies. So next are short-term loans. So short-term loans are extended for less than a year and are more popular or the most common type of commercial loans that banks make to small companies. So there are also home equity loans. So many entrepreneurs use their equity that they have in their homes to finance the startup of their business. Um, Another is commercial loans. So business owners will usually repay the loans, which is unsecured secured loan because a secured loan is a lot more expensive to administer and maintain. So there are also lines of credit. So what a line of credit is a short-term loan um, with a preset limit that provides a much-needed cash flow for everyday operations. So last is floor planning. So floor planning is a form of financing frequently employed by retailers of what they call the big ticket items, and, and that are easily distinguishable from one another, such as vehicles, boats, or other major appliances. Next is non-bank sources of capital. So to start this section off, I want to talk about asset-based lenders. So across the U.S., there are nearly 3,400 asset-based lenders. Those which include smaller commercial banks, commercial finance companies, or specialty lenders, which allow small businesses to borrow money by pledging idle assets like accounts receivable, inventory, or purchase orders as collateral. So accounts receivable is the most common form of secured credit. So with this, a small business can borrow an amount equal from 55% to 85% of its receivables. Next is inventory finance. So with inventory, a small business loan is secured by its inventory of raw materials, work in process, and finished goods. So last is purchase order financing. So small companies that receive orders from a large company can use those orders as collateral for loans. All right, so next I want to talk about savings and loan associations. I want to talk about that, credit unions, and also small business lending companies. So savings and loan associations specialize in loans for real property. Savings and loan associations also offer financing on commercial and industrial property. Next is credit unions. So they're non-profit financial cooperatives that provide loans to their members, who are best known for making consumer and car loans. So lastly is a small business lending company, and they make only intermediate and long-term SBA guaranteed loans. So they specialize in loans that many banks wouldn't pursue on a nationwide basis. So next is federally sponsored programs. So it starts off by talking about the Economic Development Administration, which is a branch of the Commerce Department who offers loan guarantees to create a new business and also expand existing business with areas of low income and high unemployment. So there's also the U.S. Department of Agriculture's Rural Business Cooperative Service. So what they do is provide financial assistance to certain small businesses through a rural business cooperative service, or also the RBS. So entrepreneurs in many small towns with a population of less than 25,000 are eligible to apply for loans through the RBS program, which they make about $900 million every year in loan guarantees. So other SBA loans. So there's is a program called the 7(a) Loan Guarantee Program. What this is an SBA program in which loans made by private lenders to small businesses are guaranteed up to the ceiling by the SBA. So these loans are a lot riskier, so their default rate is higher than a standard bank loans rate. So there's also Section 504 Certified Development Company Program, which is the second most popular SBA loan program. It is designed to encourage small businesses to purchase, fix assets, expand facilities, and create new job opportunities. There are 3 lenders in every 504 loan. So there's a bank, the SBA, and a credit certified development company. Next is Small Loan Advantages, which is designed to encourage existing experienced SBA lenders, which are also known as preferred lenders, and that it's allowing them to make smaller loans, which will benefit disadvantaged borrowers. So there's also the Capline program, which offers short-term capital to growing companies seeking to finance seasonal buildups in inventory or accounts receivable. So there are also loans involving international trade, which include Export Express program and Export Working Capital program. So the Export Express program is an SBA loan program that offers quick turnaround times to small companies that are developing or expanding their export initiatives. So Export Working Capital program is an SBA loan program that is designed to provide working capital to small exporters. So there are state and local loan development programs that I want to mention. First is the Capital Access Program, or CAPS. This is a state tending program that encourages lending institutions to make loans to businesses that don't qualify for the typical financing because of their higher risk. So next is the Revolving Loan Fund, which they combine private and public funds to make loans to small businesses, usually below market interest rates. And last is Community Development Financial Institutions. So they designate at least a portion of their loan portfolios to otherwise unbankable business owners and entrepreneurs. So there are also other methods of financing. There is factoring accounts receivable, leasing, and credit cards. So a small business can sell its accounts receivable to a factor. So what a factor is a financial institution that buys businesses' accounts receivable at a discount. So next is leasing. It's a small business. So small businesses can lease any asset like office space, computers, and also like heavy equipment or something big. So when a business leases expensive assets, they're able to use them without locking in valuable capital for an extended period of time. And lastly is credit cards. So a study by the Kauffman Foundation reports that 7% of the money for startup companies come from credit cards, and 58% of new companies rely on credit cards for the first year of business. So I was reading an article titled "Getting a Loan for a Small Business." So it states that many new owners made the mistake of taking out too many loans too quick. They advise exploring other means of structuring their business. They explain that minimizing the amount of loans that you have to take out um, and until the business customer base and cash flow are flowing more smoothly. So, if you don't have a well-established business, it's going to affect you later on when you're um, trying to get those loans, because you're not going to be able to pay those back. So, and that's all I have. And thank you guys for listening.